I'm starting, yeah?
Yes.
Yeah.
Okay.
See, own credit. So IFRS 9 requires that financial liabilities which are designated as measured at fair value through P&L are treated differently. So this is as per the IFRS 9, the latest standard. See, in this case, the gain or loss in a period must be classified into. See, why will you treat the liabilities in this case? I'm speaking about what kind of liabilities? Bonds, correct? Hello?
Yes, sir.
Bonds issued by the company. So, gain or loss resulting from credit risk and other gain or loss. So, what is this? Let us see. This change to IFRS 9 was made in response to an anomaly regarding changes in credit risk of a financial liability. What do you mean by credit risk? If the company like borrows money from people by issuing bonds, company's credit worthiness can deteriorate. Am I right? Or it can improve also.
Yes.
That is called credit risk.
Okay.
So changes in the financial liabilities credit risk affect the fair value of that financial liability. Of course, if the credit worthiness of the institution, that means the company, deteriorates, then what happens? The company has to pay more interest to the bondholders. Am I right?
Yes, sir.
Understood fact. That's a simple thing. So changes in financial liabilities credit risk affect the fair value of financial liability. See, company's bad performance creates ripples in the market. So people will demand more interest, seeing the risk. This means that when entities' credit worthiness deteriorates, the fair value of its issued debt will decrease. Correct or wrong? The market value will
Yes.
decrease.
Decrease.
So financial. So here we are speaking about financial liabilities, especially bonds, because loan and all, that's not a matter of concern. But bonds, it's a security. It's an investment done by the investors, people. So its value will decrease.
Yes.
So for financial
Yes.
liabilities, yeah, measured using fair value option, this causes a gain or loss to be recognized in the profit or loss for the year. So for financial liabilities measured using the fair value option, if the value of the security increases, it's a gain now. If the value decreases,
Yes.
it's a loss. Correct or
Loss.
wrong?
Yes, sir.
And this is for trading securities, so it will be shown in the P&L only. So statement of profit or loss and other comprehensive income, liabilities at fair value, except derivatives and liabilities held for trading purposes. Change in fair value we are showing in P&L. That's it. So many users of financial statements found this result to be counterintuitive and confusing. Accordingly, IFRS 9 requires the gain or loss as a result of credit risk to be recognized in OCI, because it is a realizable nature income or non-realizable nature income.
Yes.
So non-realizable, na?
So can you repeat once again?
See, many users of the financial statements found this result to be counterintuitive and confusing. So what IFRS 9 has done is, instead of showing in the P&L, you show in the OCI. Okay.
Okay.
Whenever there is a credit risk, and because of the credit risk, the company's performance, company's bond value deteriorates, there's a loss. If it goes up, there's a profit. You show in the OCI, they are saying.
Yes, sir.
So the other gain or loss is recognized in the P&L. So we will see what happens. So IFRS 9 presentation, profit or loss for the year, liabilities at fair value, market value, change in fair value from own credit. Because of the credit risk, what has happened? The value has decreased, correct? So it has
Yes.
gone to 90, and then we have shown that in
OCI.
OCI. So fair value gain on financial liability attributable to changing credit risk. So maybe from 90 it has gone to 100. So there's a gain now. So we are writing 10
Yes.
here. That's it.
Yes, sir.
In OCI section. So gains and losses. Instruments at fair value through peer profit or loss, gains and losses are recognized in profit or loss. Instruments at fair value through P&L. That means these are the securities which are held for trading purposes. Whenever I speak about profit or loss, trading purpose. Whenever I speak about held for sale, OCI. Understood, now? We yesterday discussed
Yes.
about the business model test. What kind of security it is. If it is held till maturity, amortized cost. If it is held for some time and then afterwards you want to sell, then fair value through profit or loss and OCI. If it is a trading security held for trading purposes, then it is fair value through P&L. Correct or wrong? We yesterday discussed.
Yes.
So financial instruments held at fair value, gains and losses are recognized in P&L unless the financial asset is a equity instrument. We are speaking about what?
Bonds.
Bonds. So if at all financial instruments are held at fair value, then you will be recognizing the profit or the gain or loss in this account, unless it is an equity instrument. And the entity made an election upon initial recognition to present gains and loss directly in equity. If at all they have already chosen this point that they will always show the gains and losses in OCI, then they will do that in OCI only. Understood? It is upon the company what they choose to do. They can show in P&L if they choose. See, and the entity.
Yes, sir. Just 1 second, sir.
Oh, okay.
Yes, sir.
So what they are saying is financial instruments, if they are held at fair value, okay, that means trading purposes, market value, gains and loss should be in the P&L only, unless the financial asset is an equity instrument. For equity instruments, you will be showing in the what?
In the balance sheet.
That OCI section. Okay.
Yes. Sorry, sir. OCI section. Yes, sir.
Yeah, financial instruments held at fair value, gains and loss are recognized unless it's a equity instrument and the entity made an election upon. See, first they will be showing initially, na. Then after that, if they
Yes.
make a choice that they will show like in the OCI, then they can do that. And dividends from investment will be always an investment income, will be recognized in the statement of profit or loss. Now there's a note. Note that when an investment held at this is sold, that means it is a security which is held for some period of time and you want to sell it. Then gain on loss or disposal will also go through
OCI.
and will be held in reserves. At disposal, entities are permitted to transfer the total gains or loss on the investment to retained earnings, but these amounts will not appear in any statement of profit or loss. So directly you will transfer it to
Retained earnings.
that's it. This is for which security? Fair value to other fair value
to
to other
OCI.
comprehensive
Yes.
income. That means these are held for sale securities. That means you want to hold it for some period of time, then you want to sell it. Financial instrument carried amortized cost, gains and losses recognized in P&L as a result of amortization process, and when asset is and when the asset is derecognized. That means you will be selling it, then you will be derecognizing, na?
Yes, sir.
So gains and losses in P&L only, because the expense also shown in the P&L only. Now, financial assets held within a business model whose objective is achieved by both collecting contractual cash flows and selling financial assets must be measured at fair value with gains and losses recognized in OCI. That means he is speaking about the held for sale security. So financial assets held within a business model. That means you want to hold it for some period of time, receive some cash flows and benefits out of it, and then after some point of time you want to sell it. So they should be measured at fair value and gains and losses shown in
OCI.
that's it. Impairment and uncollectibility of financial assets. See, impairment should always be shown in the OCI only, na? This is the almost all these two sections and some factoring.
The impairment
What, Amma?
impairment loss will show in P&L, na, sir?
No. P&L only. Yes, correct. But let us like
Yes.
discuss a proper discussion we can do. So the new impairment, see, this is IFRS 9, not different standard. So the new impairment model in IFRS 9 is based on providing for expected losses. That means you expect the securities to go down, and applies for financial assets held at amortized cost and fair value to other comprehensive income, because these are the only ones which you are going to hold. This you are going to hold till maturity. This you are going to hold for some period of time and then sell. So definitely both the securities can fall. Am I right?
Yes, sir.
And that can fall because of the deterioration in the credit quality. Correct?
Yes, sir.
Or improvement can also happen and deterioration can also happen. So on initial recognition of asset, the entity creates a credit loss allowance equal to 12 months expected credit losses. That means because of the credit loss, if the security value can go down, so like a impairment allowance account would be there, na? Like that credit loss allowance account they are creating. This
Okay.
is calculated, just a second.
Okay.
This is calculated by multiplying so this is a different kind of concept and they don't have this in details for you. Okay. So how will you understand the deterioration of credit quality of a security? You need to take that security value. This is calculated by multiplying probability of default occurring in 12 months by the expected credit losses that would result from that default. So you need to take that security value, probability of default, you should multiply. So you'll be getting like how much money how much default. See, probability of default means what? The credit quality deterioration. If the credit quality goes down, then only default can happen, na?
Yes, sir.
But these things are not given to you in details. I don't think in Kaplan also they have given this.
No idea, sir.
No, they did. If they would have given, they would have given. As per the syllabus, it is not there.
Okay.
So that I think they'll be giving in corporate reporting. So
SDR.
after recognizing the asset, entity creates a allowance for 12, that is equal to 12 months expected credit losses. That means they expect that some amount they will keep aside. They will think that this much provision, this much default, this much loss can happen because of the default. So that how will they calculate that amount of the credit loss allowance? By multiplying the security value with probability of default. Correct?
Yes, sir.
Expecting that this much default can happen. So if credit risk increases significantly subsequent to initial recognition, the allowance recorded to present 12 months expected credit losses replaced by allowance for lifetime expected credit losses. That means if you have created an allowance and you think that a higher amount of default can happen because of a higher credit risk, then you will be making a different account called lifetime expected credit loss. If credit quality improves, then this loss can be reinstated. Am I right?
Yes, sir.
The movement in the allowance is recognized as an impairment gain or loss. That means if things go well, then it's a gain. If things go down, it's a
Loss.
loss. So if the credit quality which has got deteriorated gets reversed, it's an impairment gain. If not, then it's a loss. And you will be showing that in the
P&L account.
that's it. This and last part is there, factoring. So that factoring is also a 10 minutes concept.
Yes. Factoring means sold only, na, sir?
Yeah, what the company does is they will transfer their account receivable to some factoring companies, and they will take finance from them. Okay, there are
The
two types.
factoring means?
Factoring means there will be some companies which will be buying the account receivables of firms and
Okay.
giving finance to these companies who have account receivables. Correct, and they will be
Oh,
charging a fee for that. I think F9 they
means,
covered.
sir, like for example, like if there is a bank which has a lot of loans, bad debts, So they will give those accounts information to another company to
Ah,
follow
they,
them up at some consideration like
yeah,
that, sir.
yeah, yes. They will
Okay.
fund. They will give 95% of the money, and
Yes, sir,
5%
yes, sir.
they make that day itself, and they'll charge a fee also, and they'll collect the money from
Yes,
people.
yes.
Like you see,
Yes, and they will
some,
follow up to those people.
sometimes what happens, SBI will transfer it to Reliance. So one guy will get a call from
Yes,
Reliance,
yes,
supposed to give us money. He will be
yes,
shocked, "Hey, from when did I take money from
yes,
Reliance?"
yes,
But this is factoring.
yes, yes. Okay.
See, I think we have almost done financial assets carried at fair value through profit or loss. This is trading securities. Okay. And
Okay.
one small point on financial assets carried at fair value, gains and losses are recognized in P&L. Already we discussed, and impairment should also be recognized in P&L.
And
What is the impairment loss? The difference, if suppose your security is
if
something you
the
are showing,
carrying amount is
fair
greater
value is
than the
yes,
recoverable amount.
yes, good, correct, very good, excellent.
Today we have done this impairment, sir, in our college.
Great.
It was very interesting. Our madam explained in a very interesting way.
So I did not explain interestingly.
Interest means not means it's understandable.
So didn't I
Yes.
explain in understandable way?
You explained, sir. I'm saying no, it was understandable.
Just joking. Fine.
Understood, sir.
So we are done with this chapter, Amma.
Okay.
Measurement, initial. See, initial measurement, just one point we'll discuss. Financial
Okay.
instruments are initially measured at fair value of the consideration uh, received received. Okay, given or received. Plus, so what is this actually? The fair value of consideration given or received. So financial instruments are initially measured at fair value of consideration received or given. That is nothing but the cost. You are selling at that price, no?
Yes, sir.
See, under IFRS 9, all financial assets should be initially measured at
Cost.
cost. Initial measurement. What is that cost? Fair value. That means you will be selling your assets to someone at what price? The price at which it can be sold in the market. That is nothing but
Fair value.
plus transaction cost, which you are incurring
Yes.
to sell this, correct? Which you need to
Yes,
pay
sir.
to agents and all. And financial liability should be measured at transaction price, that is fair value of the consideration received. That's it. That means the price at which you are selling it.
Yes.
The price at which you are selling, you are issuing your bonds. So
Sure.
financial liabilities, I'm speaking about bonds, should always
Okay.
be measured at transaction price. That is
Transaction price.
how much you're borrowing from them and giving them the bonds at some value. That means you're
Okay.
agreeing to make them payment of some $1,000, something like that, correct? But
Okay.
this is
Okay.
your redemption value. This is not the one we are speaking. We are speaking at you have sold them bond at
Fair
what price?
value. Fair
Fair
value.
value. Fair value. That is the market value as on that day. Okay?
Yes.
Market value as on that day.
Yes, sir.
So we have done this. We have also discussed about this. We have discussed about this. So initial recognition of the financial asset, fair value plus transaction cost. That means market value plus transaction cost. And liability, fair value, nothing but just
After
fair.
consideration received.
Yeah, just fair value. Yeah.
Okay, sir.
Factoring also understood, now.
Yes, sir. Once can you explain again?
See, factoring we discussed now right now that
Yes, sir. Yes.
one of the company will be selling all the receivables
Yes,
to
sir.
other
Yes.
company.
Yes, sir.
See, there are two types of factoring that also I will discuss, and then we can wind up this session because almost all done.
Okay, sir.
One small example. See,
Okay.
receivables can be factored. That means factoring can happen in two ways: with recourse, without recourse.
Okay.
With recourse means if you are giving the factoring, that means you are selling your receivables to factor company.
Okay.
With recourse means whatever the risk and benefits are there, that means default or anything can happen from customers, you should take care.
Yes.
Without recourse means you should not take care, they will take care.
Okay. Means with recourse
Bad
means we
debts,
are
bad debts
not
and
giving that responsibility.
yeah, with recourse means you should take. responsibility. Without recourse means they will take responsibility.
Okay.
So a company has a cash shortage and 50,000 of receivables collectible within 3 months. Company doesn't have money and they have these receivables. It sells the receivables to factoring company for, you know how they will sell at less price only. See,
Yes, sir.
50,000 is the receivables now, but they sold it for
Yes, sir.
40,000. The 10,000
Yes,
the
sir.
company has already got it. So
Okay.
that company, factoring company, the factory company will collect and retail 50,000 full as it falls due. Factoring
Yes,
company
sir.
bears the liability of bad debts. This is called without recourse. So in
Yes,
without
sir.
recourse, who will take care? Factoring
For the
company.
factory company.
You should take care. That's it.
Yes, sir.
Done, Rajeshwari. This chapter is done.
Okay, sir.
And so whatever the charges are there now for factoring, you should show that in the P&L as an expense. Okay.
Okay, sir.
Factoring of receivables.
So under which, sir, in P&L?
P&L. See, expenses only, na?
Means like in which category? Finance costs or
Finance
like
cost.
that?
They are financing, na?
Finance costs. Okay,
Yeah,
sir.
finance cost.
Okay, sir.
So this is done.
Yes.
Much of the factoring question won't come to you.
Okay.
Okay, just theory will come because they did not give this in your syllabus.
Okay, sir.
Just a second.
Yes.
Obligation repayment should be removed from. Okay, we'll discuss this. Where the seller has retained no significant risk and rewards relating to debts and has no obligation. Seller is nothing but the company which has sold the receivables to factor.
Yes. Yes,
To
sir.
repay amounts received from factor, receivable should be removed from statement of financial position and no liability shown in respect of proceeds received from factor. Okay,
Yes,
please
sir.
list this point. Where
Yes,
a
sir.
seller has retained no significant risk and reward relating to debts and
Means
has
without recourse, na, sir?
yes, and has no
Yes.
obligation to repay amounts received from factor. The receivable should be removed from statement of financial position and no liability because they sold the receivables to factor. Now nothing is there.
Yes.
A
Yes.
profit or loss should be recognized, calculator's difference between the carrying amount of the debts and the proceeds received. That
Okay.
means if you sold the debts
Means
which are
50,000 minus 40,000 from the previous question.
yes,
Okay.
where the
Yes.
seller does retain significant risk and a gross asset should be shown in the statement of financial position. That means if they are bearing the risk, they will show in the statement of financial position. Correct?
Yes, sir.
If they are not bearing, they won't show because who is taking
Yes,
care?
sir.
Factor. If they
That
are showing,
factoring company.
yeah, and if they are paying any charges, they should show it in the P&L. That's it.
P&L. Okay, sir.
Factoring cost.
Yes, sir.
Done with this chapter, Rajeshwari.
Yes, sir.
I would have taken. I have to go in a wedding, my niece
Okay,
wedding.
sir. Okay, sir.
Tomorrow, what we will start? We'll start revenue from contract with customers.
Yes, sir. Revenue and this taxation.
Yeah, 2 chapters are there. I'll finish.
Yes.
Tomorrow, revenue I
Yes.
will wind up almost all, and the taxation will take one class, or madam will take.
Okay.
Okay, you told to me to take me,
Yes.
me the class. Now
Yes.
we'll see. If madam is taking that class, we can start our solving the questions, Rajeshwari.
Okay,
That is
sir.
more
Okay,
important
sir.
right now. Need of the
Yes,
hour.
sir. Yes.
So madam will take the taxation class day after tomorrow. I will finish revenue. I will take the statement solving day after tomorrow, 9 o'clock. Okay?
Yes, sir. Okay, sir. Okay, sir.
Okay. Then done. Yeah. Thank you.
Yes.
Thank you so
Yes.
much.
Thank you, sir. Thank you,
Thank you.
sir.
Bye. Tomorrow surely I'll take at 5:30. Be ready.
Okay, sir. 5:30.
5:30 or 6. Yeah.
So I need to see, sir, because tomorrow
Okay. No.
afternoon we have this
I will.
FM class. I will inform you, sir.
I will call you at 5 p.m. and we'll discuss. Fine.
Okay, sir. Okay, sir. Thank you, sir.